Welcome to Investment Ideas. I'm your host, Ed Harrison. Today we are talking to Luke Gromen of FFTT. The Fed is about to do some very funky things with interest rates going forward. Luke tells us what he believes is going to happen later this year and how you should be positioned in terms of your investments over the next 6 to 24 months as a result. Luke Gromen, it's great to have you here back on Real Vision, and I'm looking forward to talking to you about what's going on in the economy, both the real economy and also in the markets, especially because of some of the volatility that we've been seeing. You know, we spoke a little bit earlier before the interview, and you were saying that this is a great opportunity for the Fed to complete a pivot. Tell me, before we go into what that pivot's going to be, what your investment idea is, given the outlook, and why that is.
Yeah, the bottom line for my investment outlook is I think you want to be long risk with a weaker dollar coming, weaker than expected, and I think long risk with a pivot towards value versus growth, pivot towards emerging markets versus U.S. And we also like gold, Bitcoin as well.
You know, we've had some guests. Actually, we had one guest very specifically on the show who had a somewhat bullish call on risk assets the way that you did. But I think his reasoning was probably a lot different than your reasoning. Where are you coming from in terms of why you think this is the move to take?
So where we're coming from is we're seeing a number of things play out in markets that are really the culmination of a number of factors we've been watching and writing about over the past 5 years. And so if we take a step back, about 5 years ago, global central banks stopped buying Treasury bonds or stopped adding to their Treasury bond portfolios on net. And what this ultimately did is force the global private sector to begin financing the U.S. government. And ironically, you would think that would be bad for the dollar, but what it actually started to do was squeeze out global dollar markets at that point. You saw a sharp move higher in the dollar beginning in the third quarter of 2014. You saw the U.S. react to this a number of different ways. You saw the United States government increase or encourage banks, regulate U.S. banks into buying more treasuries through HQLA. You saw the U.S. SEC regulate money market funds in the United States into buying more treasuries. You saw the U.S. government pass Obamacare or ACA, which, if you read articles at the time, the Wall Street Journal talked about it as a measure to reduce deficits, was one of the benefits. And so you're basically pushing government costs off onto U.S. consumers. And so it was all sort of a patchwork to try to have the U.S. Funded more by the global private sector as opposed to the foreign official sector as it had been for a long time. That worked up until 3Q16, when effectively the higher interest rates caused by the crowding out, the higher dollar, and the reduced consumer dollars in pocket as a result of higher out-of-pockets with healthcare costs led to a slowdown in the U.S. economy. You saw U.S. deficits rise as a percent of GDP for the first time since 2009. Now, historically, that had only happened where you saw deficits as a percent of GDP peak and fall only 7 prior times in 50 years. And in 6 of those 7 prior times, the U.S. was in recession within about 12 to 14 months, sometimes shorter. The one time it didn't go into recession was in the mid-1980s, when you had the dollar devalued significantly at the Plaza Accord. And so our call at the time, in the end of 4Q16, which was pretty contrarian at the time, was we think the dollar is going to be weakened, because if you don't, you're going to get into a recession scenario in 2017. And if you get that, all bets are off because of where the U.S. and the global fiscal situation is at the sovereign level. And so 2017, you saw the dollar fall 12%. That bought some time. We came into 2018, and there was talk of global coordinated growth, and the dollar began to strengthen, and we quickly saw that what many thought was global coordinated growth was actually just dollar down 12% in 2017, because the dollar short cuts both ways. If everyone's short dollars and the dollar falls 12%, everyone's got more money effectively in their pocket, and that's what happened throughout 2017 as the dollar weakened. So as we move through 2018, you got into the third quarter or late third quarter of 2018, and something very important happened, which was that the hedging costs for foreign investors to buy U.S. treasuries went negative. In other words, for a Japanese or German private sector investor, and again, the U.S. government is now critically reliant on foreign private sector investors to buy treasuries, the yield FX hedged turned negative. And so, people looking at nominal yields, it still looked like it made sense. But the reality was, is if they wanted to hedge the risk of the dollar, they were going to have to take a negative coupon on Treasuries, which was a problem because in 2018, the United States government issued gross $10 trillion, with about 70% of that less than a year of maturities. This year, they're on pace to issue $11.5 trillion in U.S. Treasuries. Again, 70% less than 1 year maturities. And so you're now talking what began happening in 4Q18 was that the global private sector began being paid not to buy Treasuries, or they would have to take the dollar risk on themselves. Some of them have done that on the margin, but the amounts involved are so big that you simply can't, you don't have the mandate, or you don't want to take the career risk to take all of that on, take dollar risk on $11 trillion in new issuance and roll. So fast forward to what this effectively did was it began shifting. We'd already shifted once from the foreign official sector to the global private sector, and that squeezed the dollar higher, squeezed rates higher. What this then did.
So wait a minute here, because because we were talking about this. My paradigm says that when you look at supply and demand, that's not the driver of interest rates globally. So, for instance, if you look at the Treasury curve, if the Treasury curve is inverted from 3 months to 3 years as it is now, it's really telling you what people think is going to happen to Fed funds going forward. So it's not really per se, I would say that it is that these rates are driven by supply demand. It's really driven by policy rates. How do you square that?
I would say at the longer end that you're exactly right.
But I'm talking even 3 months to 3 years, because that's the belly of the curve.
Sure. When you look at LIBOR, for example, right? So you're talking about offshore Eurodollar rates. They bottomed the second foreign central banks stopped buying Treasuries. 3Q14, you started sucking that dollar liquidity out of the global system, and LIBOR began rising. The U.S. was also tapering at that point in time as well, no question. I think when you look at what happened here in the 4Q18, it's very clear that when on the margin, your foreign private sector investors, their choice all of a sudden is I can buy a JGB at 10 basis points, or I can buy a U.S. Treasury hedged at negative 45 basis points, or I can buy a U.S. Treasury unhedged at 2.25%, 2.4%, whatever it was at the time, 2.5%. But my risk there then is that I get another 2017 in the dollar, and I lose 4 or 5 years of coupon if the dollar goes down 12%. That's the risk they're taking, and they're probably going to lose their job and assets with that. And so what that did was it forced, on the margin, more of the United States deficit onto the U.S. private sector. Mm-hmm. U.S. banks. So you can start to see, even in the 4Q18 risk off, yes, yields came down, but the tails on auctions were consistently very, very large. If you look at charts of primary dealers' holdings of Treasury starting in the fourth quarter of 18, they are up and to the right at a 45-degree angles. Primary dealers were having to take down more and more of this. And so what all this was doing was crowding out the U.S. It was creating a dollar shortage in the U.S.'s own banking system. This came to a head on March 20th. Fed funds rates rose above interest on excess reserves, and there was talk at the time that this was tied to tax season, which made sense. There's a lot of dollars moving in and out of the system around tax day. Tax day came and went, and FFR, Fed funds, remained above IOER. The Fed clearly was aware of it because about 4 weeks ago they cut interest on excess reserves rate, which should have injected more dollar liquidity into the system. It did normalize Fed funds a little bit, but it remains above IOER. And so what this is telling you is that the Fed is losing control of Fed funds rate at the short end because U.S. deficits are growing as fast as they are, and because foreign official sector is not buying really at all on net. The foreign private sector is not buying enough. They are buying some unhedged, but not nearly enough relative to the size of the deficits we're running. And so it's primary dealers, it's U.S. banks. Basically, what it's telling you is the Fed is being forced into a decision where, and this ties into our point of why are we bullish on risk assets, which is the Fed is losing control of the price of money in the United States. Fed funds moving where it's moving, it shouldn't be. And so the Fed's entire reason for existence is to control the price of money in the United States. And so the Fed is going to need to make a choice very soon. They can either cede control over the price of money, in which case we don't need the Fed anymore.
Right.
Or they're going to have to cede control over the quantity of money in order to control the price of money. And we think that's the choice they're going to make. We think that's basically the message when they came out and cut interest on excess reserves. That was the first signal. They know something's wrong. Now, what's really interesting in all this is unemployment's at 60-year lows. The U.S. economy is definitely slowing, some areas faster than others, but it's not bad. The economy's still decent. But the reason, we were talking before we came on camera that there's now over a 50% chance we get a rate cut in June or July. I don't think it's fully appreciated yet. The reason reason markets are pricing that the Fed is going to cut rates so aggressively in the back half of this year has nothing to do with the economy. It has everything to do with Fed funds, with them losing, the money markets are pricing in that the Fed is losing control and is going to have to react.
So you don't buy any of this trade stuff. You think that's a red herring, the whole concept that trade is really what we care about. We think that's going to, because the NABE came out, the National Association of Business Economists, saying that by the end of 2020, we're going to have a recession. It's going to be trade issues that's going to cause that. You're not buying that as the proximate reason. You think that it's actually what's happening with the Fed and...
I think trade is an issue. The primary issue is that the U.S. government deficits matter for the first time in 70 years. For 70 years, everybody else funded America's deficits. Foreigners funded our deficits. And so we could run deficits without tears. Beginning in 3Q14, the period of 70 years of deficits without tears for America began ending. And then they started ending faster in 3Q16. And then they began ending really faster in 4Q18. And as of March 20th, the alarm bells started going off at the Fed. When Fed funds went over interest on excess reserves, that was a sign that the United States government's deficits were getting so big and foreigners' interest in Treasury bonds, because FX hedge yields were so negative, though the interest from foreign private sector investors was so low, that we are crowding out our own banking system. And so the Fed is if the Fed does not inject a significant amount of dollar liquidity soon, be that via repo, be that via rate cuts, and I think you're going to be seeing QE probably in 6 to 9 months at the latest, then, in terms of regrowing the balance sheet, then yeah, absolutely. I think you'll have a recession probably sooner than mid-2020. It would be a very bad scenario. You'd see strong dollar. We don't think that's going to happen because we just don't think. To believe in that scenario, you have to believe the Fed is going to stand by and do nothing and basically say, we're not going to control the price of money in the United States. I think there's very little chance of that happening, and because of that, we're very bullish on risk, because if you look at positioning, the dollar, the bullishness on the dollar is extraordinarily high right now. It's not just positioning, but confidence, right? It's not just batting average, it's slugging percentage. There are lots of bulls, and they are extraordinarily confident. The positioning on bonds has gotten very extreme. The negative positioning on equities has gotten very extreme. And as I go around and talk to customers, as I talk to, as I read stories, I'm on Twitter, the appreciation that the Fed is going to have to cut rates for nothing to do with the economy, and basically, in plain English, what I'm saying is the Fed is going to have to cut rates to finance the U.S. government. And I think once they start doing that, people are going to see through that pretty quickly. Global markets are going to see through that pretty quickly. And what that means is I think the dollar is going to head, notably lower. I think risk assets are going to head notably higher, led by value versus growth, led by EM versus, U.S. in particular. I think gold will do quite well. Some of your commodities could do quite well, et cetera. That's what I think is really the primary driver, and I just don't get the sense that's fully appreciated at this point.
Talk to me about some of those asset classes that you're talking about. So say we're looking at July rate cut, that has a positive impact in terms of people's thinking about recession, in terms of the Fed's ability to maintain interest rates. What happens with things like gold? What happens with things like junk bonds in particular?
I think gold probably does quite well. I think whatever the Fed does in July, it's going to be a down payment on what they have to do, because the reality is, with FX hedge markets where they are, with the FX hedging markets where they are, you're going to need either a significant increase in rates or a significant decrease in the dollar in order to make FX hedging markets to make treasuries attractive again on an FX hedge basis, where people don't have to take on the currency risk themselves. And so ultimately what that suggests is that any rate cut you have, because, again, the reason why all of this is happening is U.S. deficits are big and growing and structural, and they're crowding out the U.S. private sector. And so basically, sort of the primary dealer of last resort, I think I saw someone say, or call it, the Fed is going to have to start bidding for these bonds again. So I think it depends a lot on messaging on July. We were talking before. If they don't do what's expected, it's not going to be good for risk. But ultimately, they're going to have to, unless they don't want to exist anymore.
And so junk bonds, you think that we already know that up until this point we've had a very low default rate in the high yield space. So you think that would continue? The Fed basically will be giving a Powell put, and then we'll continue to have a rally in the United States. The economy will actually, it's not that it would do well, but it won't fall into recession.
I don't think it'll fall into recession. And I don't think Powell's going to like it. I don't think the Fed's going to like it. But I don't think they have a choice. They've sort of made their bed, and now they're going to have to lie in it. And so, when I see things like Lael Brainerd, the Boston Fed, 3 or 4 weeks ago, bringing up yield curve control, that they might have to do that in the next recession. And Clarita had talked about that back in February. They brought it up that it was during World War II the U.S. did this. Well, if you look back at the data, the Fed pinned 10-year yields at 2.5% from 1942 to 1951. And they basically said, we'll buy every 10-year you issue at 2.5%, no questions asked. So they controlled the price of money, and they ceded control over the quantity of money. And as they did that, in those 9 years, the S&P 500 rose 5x in 9 years, CPI rose 4x in 9 years, and 10-year Treasury holders got paid every dime they were owed, but they lost between 75 and 85% of their money relative to stocks and relative to CPI. And I think that's where we're going. And so to directly answer your question regarding junk bonds, I think you'll see spreads continue to narrow, and it will be it'll probably be hard to watch, from when you look at the sustainability of it. But again, because this is being driven by the combination of U.S. federal government, deficits are going to grow structurally, unless something happens in the next, month to 75 million baby boomers. These deficits are going to go structurally for years and years and years. And unless something happens sharply to the dollar on the downside or sharply higher on rates, to make it attractive for foreign private sector investors to buy treasuries again on a hedged basis, which is what they need to do for the amounts involved. They're not going to buy trillions of dollars unhedged. They can't afford to take that kind of risk. Then this is how the Fed is going to have to sort of step up and basically fund the U.S. government.
You mentioned something in there in that last comment that I thought was interesting, because in terms of the last time that the Fed talked about pinning rates on a longer-term basis, that is, out to 10 years, which I know the Japanese have talked about doing as well. Mm-hmm. There was a loss in terms of, in real terms, in inflation-adjusted terms for the people who are investing in those markets. Where do you see inflation heading in this environment? Because a lot of people are talking about inflation going down, disinflation or even deflation. But it sounds to me like you're talking about the opposite.
I think you're going to see asset price inflation accelerate. I mean, it's obviously we've had a lot of asset price inflation for the last 10 years. I think it's going to continue and even accelerate. And as far as other types of inflation, I think it too will accelerate. But I think you will get into, you may have to look at the path of it, right? In other words, we start with rate cuts, or we start with a big repo program from the Fed, and that kind of staves off inflation, but the deficit's going to keep growing, and so then. Eventually, a couple months later, we're going to get to QE or where they start growing the balance sheet again. And at that point, you probably start to see yields back up. Maybe you start seeing yields back up, at the long end even before then, in expectation of inflation. Ultimately, because of the amount of deficits involved, the structural nature of them, and again, where the dollar is today and where rates are today, we can't. The United States economy has shown. It can't afford the 10-year over 3.2, 3.25%. And the 10-year would need to go higher than that to make FX, at least earlier this year would have had to go higher than that to make make FX hedge Treasury yields attractive to foreigners. So that option's out. So then the other option is the dollar would have to weaken significantly in order to normalize those FX hedging markets. And that weaker dollar would be very good for risk assets. It'd be good for inflation. So I do think we'll see a pickup in inflation, more on a lag. I think you'll see it in asset prices first.
Mm-hmm. Interesting. Now, gold. Why do you think gold's good in this environment?
I mean, I think the sort of the standard reasons. A lot of people talk about gold in terms of if you're seeing a pickup inflation, or if you're seeing more monetary stimulus, then all else equal, that's good for gold. I think there's a couple interesting things now that haven't been true either ever or for a long time. The first is that it's actually in the Fed's interest to have gold rise for the first time in a long time. They have a very hard time generating inflation, according to them. Well, if gold hit 1,400 and broke out to the upside, or 1,450 or 1,500, then all of a sudden there'll be some messaging there that, hey, we're doing our job. The second thing is that it's been 100 years since we've had a global sovereign debt crisis, and that's really what we're talking about here, where we've gone through this period of time where sovereign debt is considered risk-free. It is risk-free in nominal terms, but it's unpayable in anything resembling real terms. And so you've seen foreign officials, central banks, back off. You've seen issues other places in the world. The bottom line is we had a crisis in 2000 and in stocks and an equity bubble, and to get out of that we kicked it upstairs to the housing markets and the banking system. And then in 2007-08 we had a banking and housing crisis, and we kicked that upstairs to the sovereigns, and we've continued to layer down on it. Well, the problem is now at the sovereign level, and they can't default. They can't default in nominal terms, but they'll default in real terms. Sovereigns have defaulted over.
So again, you think that over time, inflation will be the bugbear, and then as a result of that, gold will be the thing that you want to get into?
I think gold, and you can see, central banks over the last 6 years have net sold about $10 billion in treasuries, and they've bought $155 billion worth of gold.
Let me play devil's advocate there, because when you think of endogenous money, the concept that the central bank, the government only controls the sliver at the bottom, and that banks are basically creating money when they engage in loan behavior. So your banking system is going to have to be fairly either leveraged, or it's going to have to be fairly flush with cash, with profits, with capital, in order for that to happen. Because obviously, when you talk about inflating, you need to have money supply go up, and that's going to be about the banks. But a lot of people think that banks are weak globally, not necessarily in the United States, but certainly in Europe, certainly in Japan. So how does that play into the concept that this is going to be an inflationary episode and not a deflationary, disinflationary episode?
I think it depends entirely. I think, to be clear, there's certainly a deflationary possibility. If the Fed stands aside, the question will be how much do they want to let it burn down. We can, if the Fed stands back and does nothing over the course of this year, they don't cut it all. What we saw in fourth quarter 18 will be a tea party. What we saw in 2008 will be a tea party. Now, what's really interesting is where we are in the cycle with global sovereign debt levels. It sounds a little flip, but it's not as flip as it sounds. At 155% of GDP, which is where the stock market is, if we have another 08 event, the U.S. will default on treasuries. And that gets you into where we are in this cycle, where
when you say default, what do you mean by that?
They won't make a coupon payment. They will need the Fed to make the coupon payments if stocks pull a 2008. That's how indebted, we are.
Let me interrupt you there for a second, because basically when I look at it, they're really the same. The Fed and when you talk about the Fed making the purchases, really we're looking at almost a consolidated balance sheet, in the sense that the Fed is an agent of the federal government. They're the agent of the government in terms of banking activities, and so the only reason that there's any independence between the two is to give us the illusion that they're not engaged in inflationary activity, exactly what we're talking about. So it's a strange thing that the Fed would be monetizing in some capacity. We saw this in Europe. We saw it in Japan.
The short answer is I think the illusion's about to be destroyed. Now, I think it's important that, and that's what I'm talking about, as you get to these long cycles, the illusion's easy to maintain when debt levels are low, when the economy's productive, when demographics are good, when you're not doing silly things with foreign policy, when you're not doing probably ill-advised timings of tax cuts, et cetera, et cetera. When you layer all those things on together, the bad demographics, the higher levels of debt, the bad foreign policy decisions, et cetera, you run out of wiggle room. And eventually, when running out of wiggle room, you have to get rid of the illusion where the Fed ends up funding the U.S. government. Now, two things. Number one, Europe and Japan have done these kinds of things. Neither of them are the reserve currency of the world, where this cuts two ways. Everyone says, gosh, look at all the dollars everyone holds overseas. That proves the dollar's position. The other side of that knife is, gosh, look at all the dollars overseas. And if the Fed just starts printing it and giving it to the U.S. government, they're going to, those FX reserves will start to be marked return to sender and sent back here. And there's only about $7 trillion of them sitting offshore. So it's a lot. They would be here bidding for our assets, causing inflation. So a lot of people say, well, if we do these types of activities, if the Fed helps finance the U.S. government, the Europeans have done something like this, the Japanese have done something like this, and they haven't had high rates of inflation, so why can't we do it? And I think it's important to understand that there's some very important fundamental differences. When you look at Europe, they are a trade creditor. They run a small fiscal deficit. They are not the reserve currency of the world. They have a positive, especially the Germans, a very big positive net international investment position. The Japanese, they are a trade creditor. They small fiscal deficit, and they have an enormous positive net international investment position. So they're getting more from assets overseas than they're paying out. They are also not the reserve currency of the world, and they have in no small measure their defense provided for by the United States. Contrast that with the United States, we are the reserve currency of the world, and so there is in theory some, there are greater offshore balances of dollars as a result of that. You've got the United States is running twin deficits. You've got the United States net international investment position is negative to the tune of 55% of GDP, and that's just by virtue of the way the system worked for the past 45 or 50 years. And so I think there's this expectation that we can do the same things and the reaction won't be the same. And I think that there's a real chance that people are going to be surprised that when we do this, because I think it's a when the Fed has to do this, that the reaction to asset price inflation, the reaction to the dollar, the reaction to CPI inflation may be a lot more pronounced than sort of the reaction that you get from people saying, well, the Eurozone did it and Japanese did it and nothing really happened. And so I think when the Fed does it, it's going to be really good for equity markets. I think you'll see there first. I think it'll be bad for the dollar. I think it'll be good for gold. I think it'll be good for emerging market assets. And within the U.S., I think good for assets in general with a slant towards value assets versus growth assets.
The first thing I think of when you say all of that is what's the exit part? In terms of when you're thinking about this scenario, when would you take profits on this particular investment?
The thing I have looked at in terms of trying to normalize equity market valuations for what's happening, which is the Fed's going to have to monetize treasuries effectively, is I have taken the Warren Buffett metric, which is equity market cap as a percent of GDP, right? That's one of his favorite metric. And what I do is I net out U.S. Treasuries outstanding, because I figure those are effectively going to have to be bought by the Fed at some point. And when I do that math, today equity markets would have to rise about 30% just to get the 2007 highs. They would have to rise by 100%. The S&P, their equity market cap, would have to rise by 30% to get to 07 valuation highs. It would have to rise by about 100% to get to 2000 valuation highs, because debt levels were so much lower then. And this is, of course, a moving bogey. For as long as markets don't go anywhere and debt keeps rising, because it will, then that number, that valuation target keeps rising. So in the near term, I would say, I think it would be a function of over the next 6 months, I think equity markets could rise pretty significantly, pretty quickly, next 6 to 12 months. I think you can get a 20% rally. At that point, you probably get some sort of pause, but it depends on circumstances. It depends on where the dollar's at, depends on where the rate's at. But I would be looking, like I said, up 15, 20% in equities before I would want to start to revisit that, all else equal.
And speaking of revisit, that was going to be my last question, is what would make you revisit the thesis altogether? How do you know when you've not gotten it wrong? We talked a little bit about if the Fed doesn't actually do what they should do or are supposed to do, but what other factors would cause you to think, okay, this investment position is not the right one?
So yeah, my two triggers would be if the Fed stands aside and basically gets rid of their own reason for existence, doesn't cut rates, doesn't supply liquidity, basically loses control of the price of money in the United States, then that would be very bad for risk. It'd be very good for the dollar. It'd be very good for short-term treasuries, maybe gold, very little else. It would be very bad for everything else. The other thing that would make me revisit and think that it's wrong is if the trade war goes hot. What we have framed is that about a year ago we coined the phrase, the U.S. might, we were worried the U.S. might call in an airstrike inside their own wire. So if you've ever seen the movie Platoon, there's a big fight at the end, they get overrun, and they call in an airstrike inside their own wire because they're better off killing some of their own guys than losing everybody. And our thought was, is the U.S. looking to call in an airstrike inside their own wire? In other words, are there interests in the United States that would rather blow up the world economy, blow up the U.S. economy, than sort of share the world stage with China? And I think those interests exist. I think those interests are, in some cases, pretty loud and vocal. And if they get their way, that could be a pretty scary world. That's a world where you could see, the dollar at 130 and gasoline at, 40 cents a gallon and spot shortages of gasoline. It would be a very, very weird world. Trade lanes would break down, et cetera. Obviously, in that case, I think it would be wrong. But I think it's uninvestable on certain levels. But that would be another area where I think it would be, where it would definitely be wrong.
Very amazing conversation. I think that for me, one of the takeaways is that the trade stuff actually does have a potential impact. Mm-hmm. And then we'll just have to see in the next 6 months when we talk to you again where that situation is and how this particular investment's played out. But I want to thank you for coming on. It's been good to talk to you about this investment thesis.
Thanks for having me on, Ed. It's always great to be here.
So there you have it. Luke sees U.S. deficits forcing U.S. domestic investors into treasuries at the expense of other investments. He believes the Fed will have to step in order to avoid recession. And so the Fed will eventually end up cutting rates and eventually even resuming quantitative easing, he says. The result, Luke says, will be a risk-on rally that will be bullish for risk assets in the U.S., but bearish for the U.S. dollar. Luke also likes gold in this situation as a hedge against currency depreciation. He recommends an overweight in emerging markets. Now, over the 6 to 24 month time horizon, Luke harkens back to 2007 and thinking about taking profits. He says that equity market cap as a percentage of GDP net of publicly held treasuries was 30% higher than it is today, and he would take profits well before that level and sees a 15 to 20% rally as a chance to take those profits.